Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our monthly market update for February 2016. We're going to walk through the major market events of the month. We started 2016 with a brutal January as the S&P 500 pulled back 5% after being down as much as 11%. February brought more of the same, as the S&P 500 once again tested the lows of the year, but rallied back more than 6% to finish the month slightly lower than where we started. A negative February brought with it the first 3-month losing streak since late 2011. The market concerns we've seen thus far in 2016 are very much a carryover from last year, and we would expect will remain in focus throughout the rest of the year. These include energy prices, central bank policy, global economic growth or lack thereof, geopolitical risk, and of course, the presidential election. These fundamental economic worries, combined with recent stock market volatility, have investors worried. In fact, we're seeing investors panicked at levels not seen since the lows in the last 2 bear markets. The latest American Association of Individual Investors survey indicates an extreme scarcity of bullish investors, even more extreme than was observed in the summer of 2015. In fact, based on the latest AAII survey, bulls are as scarce as they were in 2009 and 2003, the last 2 major market bottoms. While these levels of sentiment are often used as a contrarian indicator, meaning this bearish sentiment could actually be a bullish signal for stocks, another important lesson can be learned. We, as investors, tend to be emotional, but it's critical not to let emotions drive our decisions. When we look at market cycles, we consistently see investors buy at highs and sell at lows, precisely the opposite of a winning long-term strategy, as fear and greed replace logic and reason. That's not to say that all decisions are wrong during these periods, but it's important to understand whether you're making a decision based on logic or emotion. Oil prices have played a major role in the story thus far in 2016, as we've seen prices move lower since the start of the year, bottoming at about $27 a barrel in February. Oil and U.S. stocks have been highly correlated this year, which is not the norm. We feel that it's important to see some meaningful stabilization of energy prices to calm fears and potentially see markets move higher. With historically high supply and no substantial gains in demand, the question is, when will supply and demand reach equilibrium? We believe that until we see excess supply worked off, it's unlikely oil prices rally in a meaningful way. 2 areas to watch here are the amount of exploration in the U.S., which we can gauge through the Baker Hughes rig count, which is down about 60% year over year, and OPEC. We've heard rumblings of OPEC freezing production and are left to wonder if that production freeze could potentially lead to cuts. While many economic factors will play a role in underlying economic growth, corporate earnings could help tell the story of stock market returns. It appears that 2016 could be a year of 2 distinct halves, with weaker earnings growth in the first half, while stronger earnings may appear in the back half of the year. Per FactSet, earnings projections for the first and second quarters are negative 7.4% and negative 1.6%, while the estimated growth rates for the third and fourth quarters are 4.7% and 9.4%. This does not necessarily mean that the market will be stagnant until the back half of the year, but it's certainly a factor to watch. As we look to the remainder of 2016, we remain cautiously optimistic, as we don't see a recession on the horizon and feel there are a number of catalysts, including stronger corporate earnings in the back half of the year, that could lead to positive returns for stocks. It should be noted that we feel some degree of caution is warranted, as certain economic headwinds could lead to a continuation of the volatility we've seen thus far. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We would also like to remind you to follow us on Twitter and like us on Facebook.